Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Diane King Hall in for Brad Smith. And here are three things you need to know this morning. The Dow has been the laggard this year, but it's having its moment in the sun with the 30 stock index just hitting its ninth consecutive day of gains. It marks its longest rally since September 2017 and its highest close for well over a year. The blue chip index benefiting from strong numbers yesterday at IBM and Johnson & Johnson. It's a different story, though, for the Nasdaq. It slumped after Tesla and Netflix took the shine off earnings season. And big tech shows its hand even more next week with earnings from the likes of Meta, Microsoft, and Alphabet. Wall Street expecting a strong showing from Satya Nadella's tech giant as it benefits from a push into AI. Meta's also going to be watched with interest, of course, following its debut of the so-called Twitter killer Threads, even as momentum there has been slowing. Wall Street analysts have pushed up their 2024 profit estimates on Mark Zuckerberg's company on expectations for monetization of that platform. And it's the fifth straight quarter of record revenue for American Express. Those shares have been slipping as it disappointed investors by keeping its profit forecast unchanged. Amex sees 2023 earnings per share at between $11 and $11.40 a share. Second quarter earnings came in at $2.89 a share on revenue of $15.1 billion. That latter figure also disappointed the street. Amex said millennial and Gen Z consumers were still its fastest growing segment and accounted for 60% of new consumer accounts.
All right, let's talk about the Dow hitting its ninth consecutive day of gains, marking its longest rally since September 2017 and the highest close for well over a year. The blue chip index benefiting from strong numbers at IBM and Johnson & Johnson. It's a different story for the Nasdaq, however. It slumped after Tesla and Netflix took the shine off of earnings seasons. Joining us now with some insight, Kevin Gordon, Charles Schwab, Senior Investment Strategist. So, Kevin, let's get into what's happening with the Dow. Is this bull durable?
It's starting to look more durable, and one of the things we've been looking for, especially because you've moved off of a major market low back in October, at least if you want to use the S&P 500 as the proxy, 9 months or so since that low. So you want to start looking for these confirmations, as we've been calling them, within the sort of below the surface of indexes. So number of companies making a new 52-week high. Is that pervasive? Starting to be pervasive in the S&P. Not as much Nasdaq, Russell 2000, or Dow, but it's a smaller, index of just 30. But that, along with what looks like small caps attempting to break out of kind of a range that they've been stuck in and surpass that early February high, has been an important marker because you need to have that cyclical participation and not necessarily a complete passing off of leadership from the likes of the Nasdaq just to the Dow or just to the Russell. But as long as you broaden that net, we think that that's a positive sign. That's a bullish sign of something that's a little bit more durable.
Yeah, and I was just looking at the S&P equal weight index too versus the S&P 500, which of course is market cap weighting.
Yep.
And it's been doing a little bit better on a relative basis as well. So the big test of whether we're going to broaden out should in theory be happening now, right? We're getting more and more companies reporting earnings. So is that going to be confirmed? Are we going to see the broadening?
If you do see it, I think you'll probably have to look a lot more below the surface, particularly like a day like yesterday. It's just one day, but I find the price action interesting where you had outperformance from the Dow and you had a pretty significant sell-off in the Nasdaq or the Nasdaq 100. In our view, given the run-up that you've seen in the mega caps, whether you just want to keep it to the Magnificent Seven or if you want to keep it to the Nasdaq 100 itself, pull a little bit of a pullback or just at least an easing in the acceleration that you've seen at the same time that under the surface indexes like the equal weight S&P actually start to do better. That's probably the most benign scenario in the way that you can see more of a catch up. So it's not going to feel as good from a headline index perspective because of the cap weighted nature of indexes like the S&P or the Nasdaq. But you would want to look for more participation under the surface, and in our view that would still be a more constructive sign.
Before we get to more talk about the Magnificent Seven and tech, so let's talk about a little bit about the banking sector. So the KBW Bank Index this week did have some strength in it. When we consider the banks in the larger context, they're kicking off earnings season, is the worst behind us in terms of the financials?
I think it depends on which part of banks you're looking at. So last Friday, a lot of excitement as larger banks kicked off earnings season because, results better than expected. You didn't really have any stress in that area as you did in the small and the mid-cap side of things for regional banks. And I think that split is probably going to be firm for a while. I mean, you can see the profitability headwinds for small and mid-sized regional lenders. It's pretty tough. And you're starting to see that come through earnings. If it's not deposit flight, that's the issue. It's the higher funding costs and the fact that they're going to struggle more from a profitability angle. So I think that the split between the outlook for maybe the next year, or at least the remainder of the year, probably favors large over small. And that fits a lot with what we've been saying in terms of a focus on quality. Because if you don't have a strong margin outlook, and if you haven't had strong margins in the past few months, probably not going to get rewarded as much in a stock price perspective.
So overall for earnings, FactSet is looking at a drop of about 7% for last quarter. Do you think things are going to be as bad as that? And of course, as always, people are focused as equally, if not more, on the outlooks. What do you think the tenor over? I mean, we're what, maybe a quarter of the way through? We're not very far in,
right.
But what sense do you have?
Yeah, I think next week is probably more of a decisive week in terms of high-profile names, but a bigger chunk of the overall index in a market cap perspective as well. But I think it's going to be this mix of, do you have a similar scenario like Q1 where the bar was lowered a lot more in Q1 than it has been for Q2, but you had in Q1 this pretty miraculous jump back into no growth, which is actually good when you consider it, we were going into the quarter at down 5% for estimates. So if you don't get that kind of a trajectory in Q2 and you don't get a boost to guidance, or if you actually get cuts to guidance, which we've started to see, in our mind, that's probably a little bit more of a needle mover for stocks at least to struggle a little bit in the second half. Not that everything has to go down, but I think directionally the rally has made sense year to date because forward earnings estimates have turned higher. So that's been a pretty key development in our view.
We want to switch gears and zero in on tech a little bit more here through the lens of one particular subgroup within technology. The world's largest chip maker, TSMC, reported its first drop in profits since 2019. That was yesterday as global economic headwinds took a toll on chip demand. The major Apple supplier also lowered year-end revenue estimates. And as we do start to get big names like Meta, Microsoft, Alphabet, they prepare to report earnings next week, what should we learn from this demand slump for chips? What does it mean for big tech's outlook? With us now, Kevin Gordon, still with us. Kevin Gordon, Charles Schwab, Senior Investment Strategist. Kevin, semiconductors are frequently looked at leading tech and then tech leading the market. TSMC is not everything. We heard from ASML as well. We haven't heard from that many of the chip makers, but sort of what can we extrapolate?
I think, well, it's certainly looked at as a bellwether for overall growth. But I think what's been interesting is you've still seen a pretty healthy split, which I think it makes sense because of just the backdrop of the economy, goods versus services. But if you want to kind of put semis in the goods category, just because of the nature of chips, versus tech services, if you kind of break it down that way, the forward earnings outlook for the services part of tech has actually continued to move higher. And you haven't gone through as much of a stumble as the chips did. So you've had a pretty healthy bifurcation there. But again, I think it speaks to the backdrop that we've been in. So if forward earnings for semis can continue to move higher, and I'm talking next year out, not just the next quarter out, I think you still directionally probably have a more solid trajectory for those parts of the market. But certainly if you continue to see estimates move lower, if guidance gets cut, then you probably have a little bit of a weaker story. And for the tech sector in general, I think it's notable that a year ago, there was an expectation that 2023 earnings for tech were going to grow by about 12%. That's now been cut to 1%. So you've had a huge revision lower.
And is the AI hype train kind of too much? When you think about, like, the chairman of TSMC said, he had a quote where he talked about the short-term frenzy about the AI demand not being able to extrapolate for the long term. And you're still seeing the effect of weaker demand for like software and that having a knock-on effect in terms of chips. And AI is just not there yet in terms of the demand picture.
Yeah, I think it's probably a long-term solution, probably for longer-term problems. I don't know if we can apply it to a short-term problem, whether it's productivity growth, which we're really struggling with right now. But if that helps from a labor picture, then yeah, I could see it being a huge benefit in the future. But it's tough to extrapolate that and just to attribute any particular segment of the market's growth right now just to AI. Plus, I think AI is just this really big net that people tend to throw, and there's a lot more nuance to it, I think. And the last thing I'll say is I don't think that it's just the tech sector that benefits from this. I think you have to look at the opportunities set across all sectors, and those who are the beneficiaries, not necessarily on the supply side of it. I think that's going to be an important distinction, not for the next month, but for the next couple of decades as this really takes hold.
I want to pick up on something that you were saying a moment ago, which is that we are now seeing a growth forecast for tech of 1%, which is very different than what the growth forecast was a year ago. But the stocks are a lot higher than they were a year ago.
Yep.
So there's a little bit of, there's a problem with that picture. So
Absolutely.
What does that imply about how big tech is going to do? I mean, we got a little taste of it with Tesla and Netflix. What does that imply for how the sector is going to do?
I think actually, I mean, certainly the outlook for 23 has come down a lot, down to 1%, but I think it's more about the outlook for 24 now that those stocks have been looking at, which there is this expectation, not just within tech, but across the board for the market entirely, that you're going to get this pretty miraculous recovery.
Is it right?
Earnings growth. Yeah, I think it's just so soon to tell. I mean, back to the example of last year, earnings growth for the year was expected to be pretty good. We've seen revisions come down substantially. I think you also have to look at it sector by sector. And the one thing that fascinates me is, we often lump stocks into the growth category or the value category.
Right.
You take two of the best performers year to date, tech and communication services. Revisions for tech significantly down, revisions for communication services up. There's a huge split between the two. So you often think of these two as heavy growth sectors, which typically they are, but they're exhibiting two completely different earnings trends. I think you have to be much more nuanced.
Is the Magnificent Seven still the winner in this space when you think about, where tech is going?
I mean, it could be. I don't think that there's any reason that they don't need to be. But I will say there's been now more of a decisive split between their share in market cap terms and then their overall earnings share. And, one of the concerns, not in a super negative way, but one of the concerns I've kind of had more recently is that, we're no longer living in the shutdown era. We're no longer just living in the ecosystems of only those companies. So it gets harder to justify, their weight in an index if they're not catching up from an earnings perspective. So if that catches up, then yeah, I think it's justified. But over time, it'd be healthy in our view to have a little bit of a convergence there, as we were talking about at the beginning of the show, and then the rest of the market starts to catch up.
All right, Kevin, stay with us.
Sounds good.
All right. Inflation showed further signs of cooling in June, rising at its slowest annual rate since March of 2021. And while investors may be declaring victory, the Fed might not be so quick to join them. Kevin Gordon, Charles Schwab, senior investment strategist, is with us to deep dive into this. So you have some expectation. There's a general kind of market expectation for what the Fed will do with where inflation is. Obviously, we know what's expected kind of next week. The majority expecting another hike. Is the market reading expectations right? Like many are just pricing July and that's it.
I think it makes sense. And, for all of the criticism and the flack that the Fed gets, I think that the one thing that they're doing pretty well is guiding the market, meeting by meeting, helping sort of all investors understand that this is probably what they're going to do. And I think actually pretty effective because you go a couple of months ago, everybody was on edge about a June pause, and then it was kind of inconceivable that they could hike again, but now they've kind of guided us in that direction. You look at market pricing and probabilities, and we're pretty much there. I think the question after that is going to be very much the same case. What's the language like? How do they come out and say whether inflation is not yet back where they need it to be in terms of trajectory? And that probably sets you up for another hike if they want to go in that direction. But, as we've been outlining and really emphasizing, even if they stop after July, after the July hike, supposing we get one, as long as inflation continues to roll over, you still have real rates that creep higher. So in their mind, I think that's kind of accomplishing the goal or getting closer to the goal where you're getting more into restrictive territory. And then, of course, if inflation doesn't roll over as fast and then it kind of stabilizes, maybe they have to readjust and recalibrate from there. But we have a ton of data until the meeting after that, between now and then, even between the July meeting and then, from a labor perspective and from an inflation perspective, too.
So at the beginning of the year, the market was pricing in cuts before the end of the year, even though the Fed was signaling that probably wasn't going to happen. What is the market now getting wrong about what the Fed is going to do?
Well, I think there's still, the market's just pushed back the expectation for cuts now into 24. So I think the Fed has been successful in sort of quashing the idea that there was going to be a cut this year. But I think it's going to be more of the same story, where Powell in particular has been emphasizing there is no sort of preset path where once they get to the terminal rate and the peak rate, then they just do a 180 and turn around right away. They would need to see a lot more developments, not just from the inflation and the labor side, but now from the growth side, because you've got estimates for growth, at least for the second quarter, now moving higher, and the expectation that there's going to be a little bit of a reacceleration. We have a lot more data to get through to see if that's actually going to hold. But I think that's probably going to be more of the struggle, because those three components of the puzzle for them are not fitting in perfectly right now. And I think that's probably what he's going to emphasize a lot more moving forward.
Speaking of components of the puzzles, you talked about the labor market, and we had that new data on jobless claims yesterday, which was, they dropped by 9,000 to 228,000. That wasn't the expectation going into that. What do you think that does in terms of the Fed's moves, not for July, but going forward?
If you stay in that kind of tighter labor environment, our view has been that they're probably going to start focusing more on that, because the trajectory for inflation has largely improved, even for some of the metrics that they're looking at. You're not back to target for something like core services ex housing, but you're getting there, and you're starting to see more of an easing. Plus, on the labor side, I think we have to keep in mind, because job growth is still relatively strong, wage growth is still relatively strong, with inflation coming down, inflation-adjusted income growth is going back up. And that's happening now at a time when you're still in a bit of a tighter labor supply environment. And I think for the Fed, it poses a little bit of an issue. Even if they don't think that wage growth is the primary driver of inflation, the fact that they think inflation and wage growth tend to follow each other, or at least move alongside each other, I think that's probably going to be more of a focus.
We've been talking to you and Lizanne for a while now, and you have been emphasizing that given all of this that we've been discussing, this the backdrop, quality is where people should be going in their portfolios. Yep. What would cause you to change that? What kind of backdrop dynamics would mean that you could get sort of more bullish on a different set of factors?
I think you'd have to. Well, the one thing I'll say is that quality takes different shapes over time. So right now in particular, and probably since December, we've been thinking that quality in the form of looking at pricing power has been something to focus on. Because right now, the difference in 2023 versus 22 is that you have real revenue growth and real earnings growth starting to contract in a broad sense for the overall economy. So
is pricing power still as important to you right now?
Oh, absolutely. Because if that's the environment where overall pricing power is just falling, by nature of inflation rolling over, you have to look for companies that have been able to withstand that and that can actually grow in unit sales or in volume terms. Those that benefited from inflation like they did last year, if they have no other strategy to kind of boost sales, then you're probably caught in a tougher place. So quality can take different shapes over time, and it can have many different faces. But in terms of moving down the quality spectrum into stuff that maybe is more high beta or tends to rally when the economy reaccelerates.
To take on more risk, in other words.
Absolutely. I think it's a little early in the sense that if we do get a reacceleration in growth, we're not yet sure how hostile the Fed is going to be to that scenario, especially when you don't have inflation back to target. So it's part of this, kind of broader story of taking a little bit of a breather and a step back. And not that we're saying don't be invested in the market or go to cash. That's never really the view that we have. It's been you can find parts of the market that do relatively well, and that kind of skew defensive.
What parts do you like right now? Is it defensive plays? What are the boring plays that you like?
Sometimes quality looks boring in a way, but as a factor, I think the nice part about it is that you can pretty much find that in any sector. So in our view, it keeps you out of this game of feeling you have to jump in and out of different sectors on a month-to-month or quarter-to-quarter, exactly, or a quarter-to-quarter basis. First of all, that's impossible. Nobody knows how to time that perfectly. Second of all, if you have that quality filter and that lens, you can kind of keep yourself in gear that way. And by the way, some of the largest names in in indexes, whether it's the Nasdaq or the S&P, exhibit a lot of those factors where it's strong cash, strong margins on a trailing and a forward basis. Right. So you can get pretty strong performance wrapped up in a quality factor.
Okay. Boring's okay.
It's okay. Sometimes it's all right.
Evan, thanks for being here. Enjoy Barbie this weekend.
I'm gonna try,
whenever you may
yes.
see it.
I know, I didn't wear my pink,
That's all
but
right.
it's
I've
okay.
got us covered.
You got
this
it.
morning.
Yeah, she's got us. All right, Kevin Gordon, thank you so much.
Thanks.
Good to see you as
Good to see
always.
you.
Charles Schwab, Senior Investment Strategist. We got much more markets action coming up. Stay tuned. You're watching Yahoo Finance.
Thank you, Alex.
What sector of the market do we not pay enough attention to?
Consumer cyclicals. I think we want to know where the economy is going. That's one of the best ways to find out where people are spending their money on discretionary purchases, so I guess consumer discretionary as well. Let's see where those are going, and that'll tell you a lot about how the consumer, which is 2/3 of the economy, is going.
Let's talk you through some movers we're watching today. American Express is slipping despite reporting record revenue in the quarter. The revenue did miss analysts' estimates, and some really interesting commentary coming from Amex CEO Steve Squeri, who spoke to our Brian Sozzi and said, right now I consider it a steady state environment because we've basically been in this environment for the last 18 months. I see us continuing to perform as the environment stays like this, and to be honest, I don't see the environment changing very much. He talked about that inflation would continue to go a little bit higher, that he didn't see the economy falling off a cliff. But I thought that was quite interesting here, sort of status quo, steady as she goes.
And it shows look, Amex, they have a stronger customer base when you compare it to, say, Visa or MasterCard. But they are seeing, continued demand through their consumers, spending holding up for travel and experiences. It's something that we've continued to talk about with different analysts and whatnot. So Amex's results showing that, they did a line item on 1.2 billion for credit losses, so that's up, but nothing
surprising.
Exactly.
What we've heard from the other
other financials, exactly. One thing I found that was interesting: their new consumer accounts, more than 60% of them are Gen Z and millennial. I mean, some of these Gen Zers aren't even, to me, old enough to have a card. I guess the 20s. High end of it, yes.
Yeah.
The high end of it,
some of the other figures that stood out to me: volume overall was up by 8%, but that was the smallest figure since the first quarter of 2021. That was also a smaller number than anticipated. Travel and entertainment spending up 14%. That includes restaurants, by the way, where they were seeing a lot of spending. And they renewed their partnership with Hilton. That's now going for another 10 years through 2033. And that is one of the longest extensions that they've ever done with a co-branded credit card. So just an interesting tidbit in there as we see travel continue to be hot.
It is. All right, we'll put a pin in that and watch that one as the market opens today. Meanwhile, another stock we're watching, shares of Digital Acquisition Corp, DWAC, surging this morning after the SEC announced it settled fraud charges brought against the company. Now, DWAC will pay a penalty of $18 million, I should say Digital World Acquisition, should it succeed in taking Trump Media and Technology Group public as part of the agreement. So I guess the market's seeing that they've put a problem behind it now.
Well, they still have to close on the acquisition. Okay, so just to explain what this appears to be all about. The way that a special purpose acquisition company works, a SPAC. You form the SPAC, and then you figure out what you're going to buy. As far as I understand it here, what the Securities and Exchange Commission is alleging here is that it sounds like that DWAC made misrepresentations before it went public, that it hadn't yet had discussions with anybody. So DWAC says, I'm filing to go public. We haven't talked to anybody yet. This is the kind of company we'd like to talk with. The SEC says, well, actually, you already had been having discussions with Truth Social, the Trump media company, beforehand. And so you were lying in these documents. So now the settlement will happen, and DWAC will pay $18 million
for the penalty
if it indeed closes on this acquisition of Trump Media and Technology. So that's kind of the mechanics for it. Of the whole thing. September 8th. Is the deadline, unless shareholders vote to extend the deadline again. It's already been extended several times. So
all right.
It is a little bit of a TBD.
It is.
The shares are obviously
the shares
up
are definitely
a lot.
Rising based on that, and maybe it's a buy the rumor, sell the news kind of situation for DWAC.
We'll
All right. Shares of AutoNation also on the move after reporting earnings that came in above expectations. The shares, though, actually, let's see, not
doing
moving
much.
a lot, actually. But in terms of its report, showing strong demand for new vehicles and services outweighing slowing used vehicle sales. I mean, in terms of they had better than expected revenue. Revenue was $6.9 billion nearly. So that was, the street was looking for a little over $6.7 billion. So
it wasn't really changed year over year, their revenue. But as you said, it did come in ahead of estimates. Earnings per share also came in ahead of estimates.
But lower than, lower than a year ago. 602 a share.
Right.
648 a share.
So the company sort of seeing some different dynamics at work in the car market. We've talked a lot about that in terms of pricing here. Used vehicle deliveries down 11%, and new car sales up 12%. So the dynamics are shifting once again. It was for a while, especially during the pandemic, places like AutoNation couldn't get the new vehicles at the pace that they wanted, and so then they relied on used cars,
vehicles, which saw a huge demand.
And now that dynamic is switching back.
Yeah, and I mean, AutoNation saying their expenses, selling general admin expenses, were 63% of profit, whereas a year earlier it was around 50%. So something to watch, but echoing some things that we've seen with, say, Carvana, and CarMax in terms of those numbers. And AutoNation saying demand for personal transportation is still strong. So, we'll see. I guess we'll continue to see how that holds up through the balance of the following quarters.
Yeah. And they're also, it looks like, making a little bit less per car that they sold. So that's also not great news for AutoNation. So it's interesting here. We're not, I guess that push and pull, lower profitability per car, lower deliveries and used cars, but beating on revenue and earnings. So like all of that equaling not much change in the shares.
No, but it kind of goes back to that theme that we've talked about in general when we're looking at earnings, this lower bar, and can they jump over that?
Right.
So yes, jumping over the lower bar and how they continue to hold up in the face of maybe possibly changing macroeconomic conditions.
Oh, look, they're pink too.
Everyone's pink for Barbie today. We've got the opening bell on Wall Street. We want to do a quick check of the market sponsored by Tasty Trade. We're seeing the Dow and S&P 500 up at the open. Dow better by about 0.25%. The S&P 500 up 0.3%. We're kind of waiting for that open on the Nasdaq. As we know, it takes a little longer to open. Up, just popped. Okay, it's up as well. Up just over 0.5%. Let's get over to Julie at the Wi-Fi Interactive.
Yeah, closing out our first real week of earnings in earnest, right, for the three major averages. We had the beginning of it last Friday, but then sort of sweeping into it here. So instead of looking at just today, let's take a look at the 5-day chart and see how we've done for the past week here for the major averages. The Dow up 2.25%. We've talked about some of the Dow components that have done well on the back of earnings. That has been fueling the gains in the Dow. The S&P 500 up just about 1%. So the Dow outperforming pretty handily there. We talked about that at the top of the show. The winning streak that the Dow has been on, and really the switch that we have seen, because the Dow is the laggard year to date. It's up in the neighborhood of 8 to 9%. The other two major averages are up double digits. And speaking of the last of that trio, the Nasdaq is only up 0.1% this week here. We had Tesla, we had Netflix, that hurt things yesterday and saw that cause the Nasdaq to tumble. And then, of course, we're going into really crunch time, really important time for the big cap tech earnings next week. That is really going to be the big test of whether the Nasdaq is going to continue, or in this case, resume the rally that it has seen. So switching on over and looking at some of the other components that we watch here, I want to start with the sectors for the S&P 500. We've got consumer discretionary and tech that are the best performers today. Materials and industrials doing the worst. And again, switching on over to the 5-day look, we've got financials that have done the best this week. Last Friday, we had the beginning of the large cap financials. Then filtered throughout the week, we've had the regionals and we've had other large cap financials. And by and large, yes, there have been some exceptions. By and large, we have seen strength happening from that group. To dig into that strength a little bit, you can look at the bank, the collection of the banks. Here again is the weekly performance for these guys. Bank of America up 9% on the week. Wells Fargo following its strong performance after its earnings, up another 8%. Morgan Stanley up 10% on the week here. So really interesting. BlackRock up 7% on the week. And the regionals, if you look there, and there wasn't any red on that screen, there's no red here either. So it really has been a strong performance by and large from both the large banks and the regional banks for this earnings season, which has really been a pretty fascinating outcome. Maybe it is a lowered bar that we've talked all about, the expectations game, but nonetheless, pretty fascinating here to see the likes of KeyBank up 17% on the week, for example. And then finally, if I can just close us out with the Nasdaq 100 and how we're doing in today's session in particular, ahead of so many big earnings next week. We're seeing a lot of green here as well. CSX, by the way, is a standout to the downside. That company reported earnings after the close yesterday, this big railroad operator, and disappointed. So those shares are down 5%. But in terms of what we think of as the stereotypical Nasdaq companies, they are up. Amazon, Alphabet, Microsoft reporting next week, and they're in the green. Not by a huge amount, but enough.
Yeah, we'll be watching that, obviously. Yeah, it's a big test for tech in the week ahead. All right, Julie. All right, let's stay tuned for more of your markets action that's ahead. You're watching Yahoo Finance.
Will markets be higher or lower at the end of earnings season?
I think lower, at least if today's any indication. Netflix, Tesla, We had very high hurdles to jump over, and so far they're not. The banks, which had low hurdles, are jumping over them. So in general, with the valuations we have, probably lower.
AI, of course, has been the buzzword of 2023, and it was back in the headlines this week. To name just a few, Sergey Brin has returned to Google. The White House says OpenAI and Google have pledged to watermark AI content for safety, and Apple is developing its own artificial intelligence systems. And now, according to the White House, some of the big names, Amazon, Google, Meta, have entered a new agreement voluntarily that will manage the risks associated with AI. So, there's a lot going on. But is the hype, the positive chatter, taking a downturn? Our next guest thinks it might be. Let's bring in Duke professor and the former chief innovation officer for the FDIC, Sultan Meghji. Sultan, it's good to see you again. You know, this year has been quite a ride when it comes to AI, and there has been, certainly in the market, a lot of enthusiasm around it. Where do you think we are in the AI hype cycle?
Well, it's great to be back. And that's a fantastic question, because so much of AI right now is just driven by marketing teams and not actually by technologies. And so I think it's not surprising at all that, when we're talking about the hype cycle, so much has been announced. There's so many, glittering logos and great press releases and arguments on social media and things like that. But we haven't actually seen a lot of work being done. And the current generation of AIs are really going to start having impacts over the next few years where they, do things like streamline back office processes and things like that. But that's a completely separate set of activities from what gets covered by the news.
Sultan, so, okay, yes, AI is supposed to take on more roles within more businesses, whether it's streamlining or being an assistant in news, apparently, whatever that means. But there's been some reporting that AI is not as intelligent as it used to be, as you layer in this, kind of machine learning from itself, and this kind of feeding frenzy on itself, making it dumber. Have you seen that in any of your research?
Absolutely. Pretty much all of the large language models out there are showing signs of, in essence, the wrong side of reinforcement learning. So in AI, you have to be really careful with the data that you use to train it. And at some point, it will, kind of stop having positive returns. It'll stop getting smarter. And you need to stop and kind of take a step back at that point and really be more focused on the kinds of data you're analyzing, or just say, what, for now, this is the best we're going to be able to do. And, we're starting to see that. I think pretty much every single major tech company's openly available LLM is showing some sign of plateauing in terms of its capabilities.
Some of them, Sultan, at least according to some reports I've seen, are not just plateauing, but getting dumber, for lack of a better word. I mean, I feel bad calling something dumb, but I guess it's not alive, so it's okay. But I get that it would plateau, but why would it regress?
Well, so many of these systems are just based on fundamentally learning from what's openly available on the internet. And let's be honest, a lot of what's out there on the internet isn't that great. And if you run out of data to train because you've looked at the entire internet and all you can do then is look at the data that has been generated on your own system, you're in essence drinking from the same well that you're feeding into. And so, it's not surprising at all to me that, I think in one report, one of the LLMs, could do math very well a few months ago, and now all of a sudden it can't even do 2 + 2 reliably. And that's, that speaks to this fact that the data that they're training these on is not growing at the rate that the systems themselves are growing.
So, Sultan, there had been some criticism about where Apple was with regard to AI, especially when you think about the context of ChatGPT and Microsoft being a front runner now there. And now Apple apparently creating its own, according to some reporting, Apple GPT, or what their Ajax, I think that's what the name is, that they're calling what they're working on. Who do you think is going to be the winner in this space?
Well, I hope you're not asking me to bet against Apple, because that seems like a dangerous thing to do. But, Apple has a long history. It's part of their culture of an organization. They weren't the first personal computer. IBM was. They weren't the first smartphone. We all had BlackBerries before that. I guess I'm not surprised at all that they've taken a slightly slower approach, a more engineering-centric approach than many of these other organizations. But they also, as one of the few trillion-dollar tech companies out there, have a massive consumer base. And the minute they decide to release something like that, millions, if not hundreds of millions of people will be using it within 24 hours. And, when you have that kind of scale, you have to be very thoughtful about introducing a new feature that has the support on the back end. One thing that most people might not realize is our growth in artificial intelligence is limited by the numbers of CPUs and GPUs that can actually do the math that makes them work. And if all of a sudden you have to add 100 million users to an AI system, you have to have a fair amount of infrastructure behind that. And it's possible that they just don't have it.
Yeah, well, that explains the enthusiasm and the demand for NVIDIA chips and shares, for example. But again, to sort of talk about where we are in the cycle with Apple sort of being a little more cautious about it, maybe we should also take a lesson from Apple. I mean, I think about all of the hype cycles that we have gone through in the past decade, from crypto to the metaverse, even to full self-driving, where the talk was big and the yield either didn't materialize at all or has been much, much slower than the proponents would have said. And I kept hearing at the beginning of this year, well, AI is different than that. That, it's such a big thing and can affect so much. Was that just fundamentally wrong, or is it just the timeline is way more extended?
Well, that's an absolutely fantastic way to frame it. And I would say it's the timeline. The metaphor that I use is the cloud. The phrase the cloud was really coined in 2007, 2008. And it's taken many organizations, through 2023 to even have a cloud strategy. And so, the US government where I worked, we weren't fully on the cloud by a long shot, still aren't. And there are time considerations that most people don't realize when you're talking about impacts of massively scaled technologies. So if we will go from 2008 to 2023 and we aren't still fully on the cloud, with AI being, in my opinion, an even more impactful technology, I wouldn't be at all surprised if we're talking about a multi-decade journey to really realize the benefits of artificial intelligence.
And Sultan, you talked about the data to train it earlier and how, I guess if you put stupid in, you get stupid out. Where does the responsibility lie with regard to training AI, especially when you think about the potential or the use case within law enforcement and just the legal field in general to prevent against discriminatory bias?
I mean, discrimination, not just in law enforcement, but also in basic things like, making credit or lending decisions. There is a tremendous risk attached to that. And so, the Biden administration, approaching artificial intelligence as a risk, which is what they've done, shows that they have thought about this front and center. The challenge is just like the internet itself, government can't do it alone. The private sector can't do it alone. Academia can't do it alone. All of those organizations, including, the average American, the average human, need to be part of this discussion because the current laws, the current regulations don't take these kinds of technologies into account. And we need new systems, new regulations, new ways of thinking about this, in my opinion. And we need to build that. And that, for the most part, doesn't exist yet. And so, hearing that some companies will, put some watermarking in there or choose to collaborate in a non-official capacity with the U.S. government is a great step, but that doesn't actually solve the broader problem.
I love that insight. Sultan Meghji, Duke professor and the former Chief Innovation Officer for the FDIC. Thank you so much for joining us this morning.
Thank you for having me.
All right. Meanwhile, 2.3 trillion in listed options are set to expire today, of which 1.1 trillion expired only minutes ago on the open. What are the dynamics at play here? Let's head right to the New York Stock Exchange, where our very own Jared Blickery, as I like to call it, from one professor to another. Professor Jared, take it away.
Well, let's take a look at what we got on deck here on the Wi-Fi Interactive. As you said, Diane, $2.3 trillion of options are expiring today, and some of those just expired on the open. That would be 1.1 trillion of index options. Those index options generally do settle in the AM on the open, so half of the battle is already over. The remaining $1.2 trillion of single stock ETFs and also index options that are expiring in the PM, that happens later today. That's typically after the close, actually on the last tick of the underlying issue that trades today. So interesting dynamics going on here. This is the largest July expiration ever. These volumes tend to increase every year. We've also seen the options market become a much bigger part of the equity universe than it used to be, especially one day to expiration options. They get a lot of love, and so some have argued that that makes the VIX less relevant than it used to be, but nevertheless, a lot of focus on that here today. Lots of volume expected already on the open, but also throughout the day into the close. Contrary to popular belief, we actually don't see increased volatility in the indexes today. It's generally only limited to some of the individual issues. Some of those issues get pinned around a certain stock price. So Apple around a big round number like $150 might get stuck there or pinned there. Others can have some wild fluctuations, but all in all, we actually tend to see less volatility on these big options expiration dates in the indices, guys.
The irony. Jared, the surge that we've seen in the Dow as of late, the consecutive days that we've seen higher, can we take anything away from that? Does it have any sort of predictability in terms of what it tells us what's going to happen next?
Yeah, I think the Dow is the people's index. Let me take a look at the Wi-Fi Interactive today. First, I'll show you the Dow, and then I'll go over the transports as I did earlier in the week, just to show kind of Dow theory, how things are confirming each other. 8 days, 9 days, 10 days in a row. The streaks don't matter to me as much as the individual performance and then the relative outperformance or underperformance to other sectors, but clearly the Dow has been leading recently. Let me take a look at the 5-day total here, up 2% versus the Nasdaq, which has been under more pressure. Here's the Nasdaq 100, it's actually down for this week, and let me find the Nasdaq Composite that has about 3,000 issues in it instead of 100. This is actually up a little bit, but there's also some things going on with respect to the Nasdaq rebalancing that could be affecting some of the mega cap names that took that big hit yesterday and throughout the week. So I think there's really just a lot going on here. By the way, that Nasdaq reshuffle that takes place, all that is going to be done on the close, slightly after the close, so that everything is ready for Monday to start trading with the new rebalance. But as Bespoke Investment Group has been noting, it's kind of a moot point here because the overconcentration issue pursuant to the Nasdaq's own rules kind of evaporated over the last 2 weeks, so that special condition that triggered this Nasdaq rebalance no longer even remains. You could say maybe the markets are a little bit self-correcting, but let's go back to the Wi-Fi Interactive. We have the Nasdaq 100 here over 5 days, and you can see indeed, more than not, the mega caps have been taking hits here with Alphabet down 4%, Tesla down 6%, and Amazon down 3%. Their Apple's still up, but you get the picture. So there could be some of those dynamics at play. You asked me about the Dow, so let me take a look at the 5-day price action in the Dow. Is it any wonder why the Dow is leading right now? Even the mega caps in the Dow are in the positive. So just kind of shows you the environment that we're in. And by the way, if you want to compare the Dow's movement to something that we've seen in the pandemic, I would point you to November of 2020 when we had the election decision and we saw just about everything lift, but it was really the value and cyclical sectors that took off in anticipation of election dynamics and what the new administration were going to do at that time. So we've seen these bouts of outperformance before. Do they necessarily mean anything? I think it's just a healthy part of a market that's going up that you sometimes have different leadership at the top.
Jared, thank you so much. Really appreciate it. Helpful stuff on options and on the Dow and that Nasdaq rebalancing. We got much more coming up. Stay tuned. You're watching Yahoo Finance. Does anyone really understand AI?
Someone does, but I think the vast majority of us do not. Think about like any subject that comes up into vogue. You have all the instant experts on it. There are people who really are experts, but they tend to keep their mouths shut because they're working for companies like NVIDIA, or they're researchers doing heavy-duty research, and they'll publish their paper, in a couple of years. So somebody knows. Most people who profess to know probably don't.
Well, despite air conditioning units seeing a lot of use this summer, natural gas prices still sit over 60% lower than they were a year ago. But as the world desperately tries to cool off amid scorching temperatures, some stocks may actually stand to benefit. How should investors play this heat wave? Pavel Molchanov, Raymond James Managing Director, is joining us now. Pavel, it's been a while. It is great to see you. And this is sort of such your wheelhouse. I'm so glad that we have you here to talk about it. Obviously, there is this heat wave that is across the globe, in particular in the Southwest U.S. We are seeing a lot of issues. And you've been looking at some companies that may be poised to help. One of the most intriguing ones, in my mind, has to do with desalination. But talk us through sort of the big picture thesis there.
Yes. Water scarcity is one of the most glaring consequences of the climate crisis. Literally, parts of the world are running out of water. Now, our listeners in California have a long history of this. But as bad as California has been in this regard, this situation is even worse in much of the Middle East, India, other parts of Asia where you have high population density and nowhere near enough supply from aquifers and rainfall. So desalination is a vital aspect of what we call climate adaptation, learning to live with systemically higher temperatures. Energy recovery, yeah.
Go ahead. No, go ahead. Finish your thought.
Energy recovery, ticker ERII, is the only publicly traded company that is nearly 100% focused on desalination. This company provides equipment to desalination plants that makes them more efficient and ultimately reduces the cost of desalinated water, makes it more affordable. So historically, most of this company's revenue came from the Middle East, where desalination is the most common, right? Places like Qatar and the UAE. But increasingly, they're selling to parts of the US, China, India, and so on.
And Pavel, really quickly we have both an investor audience and a retail investor audience. Can you explain what desalination is?
Desalination means taking water from the ocean, removing the salt. This takes a lot of energy, right? Water goes through these membranes, salt is removed, and the result is potable water suitable for drinking, cooking, everything else. Only about 2% of the world's water supply is desalinated today, but that percentage will only go up over time because the climate crisis is making water shortages more common and more severe.
And Pavel, sorry, it's not only is it complicated to do, it is also expensive to do. So when you talk about it being most common in the Middle East, that's not just because there's a need there, but there's also probably the financial resources there to pay for this costly process. So how big a market is there realistically, and is the price coming down, especially when there's only one pure play publicly traded company that does this?
Well, to clarify, the desalination projects themselves, these billion-dollar plants, are built by utilities, a lot of them government-owned, places like Saudi Arabia. So Energy Recovery does not build the project. They provide some of the important equipment used in those projects. And in fairness, there are some large industrial companies that are involved in desalination, but it's just a very small part of their business overall. Is desalination expensive? Yes, it will always be more expensive than getting water from rain or from underground aquifers, right? It costs a lot of money, takes a lot of energy to break the water molecule and remove the salt. But here's the reality. In the world of more intense heat waves, as we are seeing right now, and the water scarcity that results, there is no choice. Communities that are literally running out of water have absolutely no choice but to build these projects Some of you may remember what happened in Cape Town, South Africa in 2018, the so-called day zero, when there was a fear that this massive city would literally have zero water available for the general population. Well, imagine that scenario spread across large parts of Asia, South America, and yes, also in the United States. It is only a matter of time.
What other companies, so we talk about a pure play there, are positioned well with what we're seeing in terms of this increasing, just a hotter earth in general? We're having these climate change issues, whether we're talking about the U.S. to Europe, melting people, melting phones apparently as well. So what other companies that are not so much the pure plays that are positioned well for this?
Just let's think about the energy aspect of this. Heat waves makes the electric grid less reliable, right? We're all living through these power outages, some of them obviously taking longer, than others. Bloom Energy, ticker BE, provides fuel cells for data centers, hospitals, office buildings, any kind of business that needs super reliable electricity 24 hours a day, 7 days a week. Bloom's fuel cells protect these businesses from disruptions to the electric grid. This is what we call distributed generation. Instead of needing to rely on the local utility, you put these fuel cells at the site of the business, and they will get completely reliable, dependable electricity without any risk that the local, weather situation will disrupt the grid.
I'm curious about Bloom in particular because the shares, well, they're kind of all over the place, aren't they, Pavel? And they're down for the year to date. Is it just because, or is it due in part to the idea that investors are not as focused on sort of the long-term solutions?
Well, look, Bloom is small cap stock. It's high beta, not yet profitable, I should say. So in a time of focus on kind of the more high visibility, maybe higher, larger cap companies, yeah, the stock is down. Indeed, that's why I think there is a buying opportunity here. But conceptually, it is exactly the events like what we're living through right now, this intense worsening climate crisis that reminds us energy resilience for both the individuals, households, as well as for businesses is an absolute must. People cannot live without water. Okay, we all get that. People cannot live without electricity, at least not for a long time. So protecting businesses from disruptions to the grid, that is exactly what Bloom is all about.
What other businesses are you worried about in the context of this increasingly hot atmosphere that we're living in?
Right. So, again, kind of along the same theme of protecting all of us from the grid shutting down, let's think about the consumer, right? The individual household. Best way to protect all of us as individuals is rooftop solar, putting a solar system on the rooftop. Only 5% of American homes have a solar system. Now, in Germany, it's 20%. Europe is quite a bit ahead. Of course, Europe has also learned the hard way during the war that natural gas from Russia is subject to being cut off for political reasons. So that's part of the reason why Europe is ahead. But Enphase Energy, ENPH, this is an S&P 500 company, by the way. It gets about a quarter of its revenue from Europe, the rest, from the U.S. This stock also has not run away from you, by the way, but it is an S&P 500, $20+ billion company. This company makes the microinverter which is an important part of these rooftop solar solutions.
All right. Pavel, we got to put a pin in our conversation. I do enjoy this conversation. I think it's important stuff that we have to think about. I really thank you so much for your time. Raymond James Managing Director, Pavel Molchanov. Let's stay with us, though. We have more of your market action ahead. Stay tuned. You're watching Yahoo Finance. It is just after 10 a.m. here in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Julie Hyman, and we have Rochelle Akufo in this hour with you. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving. The S&P 500 attempting some gains as a busy week draws to a close. Big tech shows its hand next week with earnings from the likes of Meta, Microsoft, and Alphabet taking center stage. Wall Street expecting a strong showing from Satya Nadella's tech giant, and Facebook's parent company could also get a boost as analysts look to growth in its Threads platform.
Well, we're also looking at Schlumberger, the oil services giant, trading a bit to the downside, off 4% after a miss on the top line offset optimism around strong international growth. The oil driller did beat the street with second quarter profit at 72 cents a share. CEO Olivier Le Peuch said he continues to see positive upstream momentum, though the picture around North America was less bullish. Stock, by the way, up 15% over the past 3 months.
And I'm watching SiriusXM Holdings stock surging this morning. Barron's reporting that shares have been driven higher by a mixture of short covering and the unwinding of a spread trade. Now, short interest recently hit 33% of the available float on one of the highest ratios of any company in the Russell 1000.
And Intuitive Surgical shares falling despite beating the street and seeing a rebound in elective surgeries. A decline in growth rates for bariatric or weight loss surgery in the U.S. appears to be weighing on shares this morning. The healthcare business announced EPS of $1.42 on revenue of $1.76 billion. Now, we've seen some big earnings come through this week from Netflix to Tesla, so let's break down some of the top takeaways from this week. Rochelle and Julie, what are you guys thinking?
I don't know. I'll let Rochelle go first.
So, I always love to talk all things Tesla. I thought it was interesting that the results themselves were good, but when a lot of people started listening in on that earnings call, especially investors looking for a lot more clarity, not just on deliveries, on things like the Cybertruck and some of the specs that we still don't hear, but also some of the softness he talked about coming up in Q3. And also this $1 billion spending on this Dojo supercomputer, but sort of hedging his bets in, saying that would only be sort of spent over the next year if NVIDIA couldn't supply the chips there. And so we're still continuing to see Tesla under pressure today. I mean, they're doing well apparently in terms of demand for things like the Cybertruck, but really honing in on not getting enough specifics for investors to sink their teeth into.
I know, and I think one of the concerns that came up with Tesla was with regard to pricing and how that moves forward. Another kind of interesting theme to note, although we've talked about the bars, so far, of the chunk that have reported more than 70% beat expectations. Now, we have continued to talk about the bar being lowered going into this earning season. We'll see if that trend kind of continues next week when we have big tech really just in focus in the week ahead.
I was really blown away by the performance of the banks, as I think many people were. And looking at, as I earlier did, Rochelle, I was taking a look at the banks, the big banks and the regional banks for this week. Both of them almost uniformly in the green, which is quite surprising given some of the sentiment around concern over net interest margins going forward, concern over loan growth, concern over charge-offs and provisionings.
And what's happening with the consumer, especially still in some of the regionals. There were still some cracks there. And you saw, maybe not the outflows that were expected, when you go back even as far back as March. So it wasn't as dramatic as expected, but there was some weakness.
Yeah, the key word in there, expected.
Again,
right?
Yes,
the low bar, perhaps, for some of these companies. All right, well, as earnings season rolls on, investors are shifting focus to next week with big tech heavy hitters like Meta, Amazon, and Microsoft all on tap. Which tech company is perhaps positioned the best? Paul Meeks, Independent Solutions Wealth Management Portfolio Manager, is joining us now. Paul, it is fantastic to see you. I can think of no better person to talk to going into these big tech earnings. So, I know we're going to kind of get into the details of each, but my big overarching question is, if I'm an investor, who am I buying going into these numbers?
So first of all, I'd be a little bit hesitant to buy any of these stocks, even the ones with the sterling fundamentals, because they've done so well, so quickly in 2023, and maybe the fundamentals don't match the stock prices. However, if you are going to peel back the onion and you take a look at the major tech players announcing next week, I'm most bullish on Meta.
So let's talk Meta, because we saw their starting to rise after they announced their year of efficiency. Investors, at that point, still really hadn't seen enough to sink their teeth into. What do you think is separating Meta from the pack right now?
Well, first of all, Meta, with the year of efficiency, has taken a lot of cuts out of the system, draconian cuts. And I expect to see more progress there, inflating the operating margin. And the company already comes to the dance with a pretty high operating margin. But when you take a look at some of the other things, whether it be in artificial intelligence, or if Apple ends up selling someday in the future the Vision Pro headset for $3,500, I think Meta is going to sell their couple $100 version of their own headset in a big, big way. And so the key thing with Meta will be what's going to happen with digital advertising, because that's still the driver of the company. And if we do have a recession, which I do predict will be next year, even though I think it'll be short and sweet, what kind of impact on the legacy business will that have? In the meantime, tell me more about the year of efficiency, continuing operating cuts. There might be more to come. What are you doing in AI? What are you doing in augmented reality? And the nice thing about Meta, it actually has, for the first time in a couple of years, some real, tangible, positive catalysts. And in the meantime, even though the stock's up quite a bit in 2023, it was down so much in 2022. I think that there's upside on the stock. I don't think the stock is particularly expensive.
Paul, you mentioned AI. What are you looking to hear from whether it's Microsoft or Alphabet on that front? Where's the meat that you're looking for? That was a big theme the last round of earnings from these tech giants.
So the last round of earnings, they essentially talked about, I'm doing it, right? ChatGPT is unveiled last November, first conference call in, companies are saying, yeah, I'm embracing that theme. Now what I need to see are some tangible benefits that are going to positively impact these companies' P&L. What are they doing specifically? How are they going to monetize it? And when they monetize it, when do we start to see the goodies? Because everybody can talk the marketing spin, but I need to see some tangible impacts on the P&L. You better give that to me, at least guide to it for the next couple of quarters, because I'm going to start to believe that it's all smoke.
And to that point then, at what point do we expect to see the shakeout here? Because obviously we're still seeing a lot of these sort of micro developments with Microsoft and with Google here. But at what point are we going to see a shakeout when we can actually say, look, these are going to be the ones really taking the lead here for the next few years on AI?
That's the ultimate question. And I think back to when I was managing big tech funds for Merrill in the inflation of the internet bubble, late 90s, early 2000s. All you had to do, whether you're a tech company or not, is just call yourself .com, and some companies did that, and you had an initial push. But then over time, you do have some mega companies that benefit from the trend, and then you have some that spun it like a top, and then just everything came out of it. So I think AI is such a new topic. I think that investors will give these companies the benefit of the doubt, but we'll need to see some real concrete benefits. But I don't think you should expect that in the next couple of quarters. It's probably a 2024 phenomenon. Then you'll start to see the strong get stronger, and then some other companies fall by the wayside.
Well, that sounds realistic in terms of timeline, right? Not waiting for that profit right away, the goodies, so to speak, that you spoke of, Paul. But do you think most investors have that realistic expectation? In other words, if these companies don't come out and do what they did last time and paper over their call with AI, are they going to be punished? Or do you think that the market has kind of taken a breath on this a little bit?
I think it's the former, and I'm a little bit worried about it, right? Because the underpinning is, the Nasdaq is up 30%, the Dow's flattish. And so you've had a real cascade upward of these tech stocks. And that really had a lot to do with AI and also a lot to do with people believing that the Fed was very close to peak interest rates. And then next year, when they start to lower interest rates to normalize them, then tech and aggressive growth stocks love that more than anything. But I do think there'll be some pressure on some companies on these calls. And you even saw with the negative reaction to Netflix and Tesla, who had otherwise pretty good quarters. But when the stock is priced where it is, if there is one fly in the ointment, and we might have some flies in the ointment when we start to see these companies report, I worry that they won't have a big drop back, but I do expect maybe a slight correction, kind of a la Netflix and Tesla the last couple of days.
Interesting. One thing, one company we haven't talked about with regard to this tech space is Amazon. What are you expecting from Amazon? What are you looking for, whether we're talking about AWS, just e-commerce in general? What are you expecting, Paul?
The key thing is AWS, right? It doesn't really matter what the revenues are. It matters where the profits come from, and they overwhelmingly come from AWS. The problem is AWS, not just for Amazon, but for the entire cloud infrastructure industry, has come down quite a bit, right? The growth rates have really slowed. What I need to see is a reacceleration or comments from management in the Q&A portion of the call as to when AWS revenues are going to reaccelerate, because the industry has been slowing down, and unfortunately, AWS has lost market share in the last couple of quarters to Oracle, Google, and some of the other major players like also Azure. So we'll see. They got to rebound that AWS growth rate, because that is the driver. I don't know if the e-commerce stuff matters that much.
And Paul, we have to talk TSMC, obviously what's going to be powering a lot of the growth that we're expected to see. And then we saw sort of that warning there about demand here. What are you making of that? Is that the canary in the coal mine?
I think it's very important, right? Because TSMC is the world's most important semiconductor company. When it comes to the advanced chips, they do it all, overwhelming global market share. And to say that they have to trim back their revenue expectation, I think that's significant. Yes, they will have an AI push, and because NVIDIA manufactures through TSM, huge positive. But in the meantime, consumer electronics, things like the iPhone, particularly if we do enter a recession, there will be less spending. And that will be a pretty stiff headwind, not maybe countervailing the tailwind, which is AI, but definitely there's going to be a mix. And you can see that, it's not all rosy just yet. But long-term investors, that's a marquee company. The only thing you probably have to worry about with that one long-term is, do the Chinese decide to take Taiwan? And then that would be an issue.
Indeed, but always great to get your insights. Paul Meeks, their Independent Solutions Wealth Management Portfolio Manager. Thank you for joining us this morning on Yahoo Finance.
Be good.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Are we ignoring geopolitical risks in the market right now?
We always ignore geopolitical risks. What kind of question? That's you can ask me that any day of the week and any time of the year, and for the most part, yeah, there's a couple times where they come to the fore, and then the market really does. Equities don't really know what to do with them, and so they get shoved aside.
Which seems like an okay decision, I guess, in the long run.
Most of the time, yeah. I mean, equity investors are very good at earnings, cash flows, all the stuff that makes stocks go. Geopolitics is way outside of most investors' ability to grasp, model, and so until or unless they become really tangible on a specific company or a specific sector, they tend to get pushed aside.
Let's do a quick check of the market sponsored by Tasty Trade. We see all three major averages in the green here today. And unlike the huge divergence that we saw yesterday between the Dow and the Nasdaq, today they're pretty much all on the same page, up in the neighborhood of 1/5 to 1/4%. We still had some earnings, of course, this morning, and really looking ahead to some big ones next week. Rochelle?
Indeed, we're talking climate now. Days of intense heat sent temperatures soaring across the southern US and Europe. Climate scientists speculate July could set a record as the hottest ever recorded month. The planet has warmed about 2 degrees Fahrenheit since the 19th century, according to NOAA, and that rising baseline makes periods of extreme heat more frequent and more intense. As extreme heat intensifies, so does the economic impact. A Dartmouth study calculated that extreme heat could cost countries between 1.5% and 6.7% of their GDP each year. Well, the co-author of that study, Christopher Callahan, is a doctoral candidate at Dartmouth. He joins us now alongside Lawrence Chandy, Principal Advisor for Economics at UNICEF. A big thank you to you both for joining us this morning. So, Christopher, I want to talk about the key findings from this study, because for a lot of people, when they talk about extreme heat, it doesn't really hit home until it happens to them. But talk about the economic findings from your study.
Absolutely. We found that because we know that extreme heat can damage crops, it can make people sick, it can make infrastructure buckle and have all these compounding risks, that when heat waves get more intense, economic growth goes down, and this can have compounding economic consequences to the tune of multiple % of GDP per capita over time. This happens most strongly in the tropical regions that are already warmest. So if you're starting out at a warm baseline, you are closer to that sort of danger zone of extreme heat. So for the moment, people in places like the United States are not suffering quite as much as places in tropical regions, but that could change as things get worse and climate change continues.
And Christopher, at the same time, even if it's on a relative basis not as bad, one would imagine that, like with the heat that we are seeing in the Southwest right now, for example, am I going to go out and spend money? Certainly not going to do it outside, right? I'm not going to go to a golf course. So I wonder if those dynamics are going to start to be more broad geographically as well.
I absolutely think they could be. I think there has been this sort of idea that the people that are most vulnerable will suffer most from climate change. And that is absolutely correct. The people that are already worst off are going to be hit hardest. But those of us in places in the United States where we have widespread air conditioning coverage, that might protect us to some degree. But as you say, people still aren't going to go outside to the degree that they might previously. And there's going to be a lot of more subtle impacts, even in the richest places in the world, that I don't think we quite have a handle on yet.
And Lawrence, I want to bring you in here because a lot of times when we do see, as Christopher was just mentioning there, it affecting the countries and the regions that already have the most heat, it can be hard for, say, investors over here who want to invest in some of these projects that would help reduce the impacts of climate change to really sort of want to take that on board. What is the incentive there, Lawrence?
Well, I think the incentive is great because there is a tremendous opportunity to invest in the green transition globally. I think historically we've mistakenly seen this as a trade-off between do we protect the environment or do we continue to prioritize the economy. I think that's an unhelpful and really sort of an erroneous framework. I think we're increasingly seeing in this century that there are huge economic opportunities for people who want to invest in the green transition. Of course, some of those investments can have huge returns. In other areas, we need to invest to protect communities, and there won't necessarily be commercial opportunities there. And that's where we need governments to step up. We need the multilateral development banks to do more. But I think that for investors out there are certainly big opportunities to be made in the green transition, and that's going to be a major driver of the global economy this century.
Do you think, as you said, we haven't necessarily seen finance move in that direction, Lawrence, but what about the governments themselves, local communities, local corporations? Have they at least started to move in that direction that you're talking about?
Well, I think the reason why the investors have been slow is because of the cost of capital to invest in developing countries. So there are reasons there that are affecting the returns to international investors, and I think that there's work that can be done to reduce that cost of capital. We are seeing governments in the developing world stepping up their investments, but you have to look at that against the backdrop of the last several years. So many developing countries have faced headwinds in the last several years because of COVID, because of the global shocks associated with the war in Ukraine, and there are certainly some of the lowest income countries have high levels of indebtedness. So they are relatively constrained in terms of being able to make the kind of ambitious, large public investments that we've seen, for example, in the US through the Inflation Reduction Act.
And Christopher, I want to talk about the labor force here, because when you do have a lot of pressure in one area, you get changes in migration patterns, and that affects upward mobility, immigration and things like that. What are some of the ways we should be looking at it in terms of a migration perspective and how that tends to affect economies?
Absolutely. To be perfectly honest, I think that's a major unanswered question. One thing that we don't yet have a great handle on is how exactly climate change is going to reshape the global population. From an immediate labor perspective, we know that extreme heat can reduce labor productivity. If you're taking a test in a warm room, you're going to do worse on that test than if you're in a cool room. But putting that in the context of the shifting of populations across borders could create opportunities for people to create sort of new market opportunities in new areas. But that comes with potential political pressures and political instability associated with the mass movement of people. And so I think as researchers, we need to be conscious of this unanswered question, and governments and the public need to be attentive to the ways that migration is going to intensify in the coming years and decades.
And Lawrence, as we have this push to electrification, that's also putting more pressure on the electric grid, but is then being compounded by these heat waves as well. So what does that mean in terms of the progress that can be made in electrification when you're trying to balance that also with the pressure coming from these extreme temperatures as well?
Well, I think that let me break that up into a couple of parts. So the first point is that certainly during heat waves, it can put a lot of pressure on power systems. You can think of heat waves as essentially sort of driving an energy shock by creating huge amounts of demand pressure on a power system. And so those countries who have relatively less resilient, more vulnerable power systems are going to face power cuts, and that's going to have disruptive effects on businesses and, of course, human effects for households. But something which we know is coming in the green transition is a much greater reliance on the grid. So much of the energy we use right now in our transport systems, for example, and in our cooling systems will increasingly we will rely upon the grid for this. There is this sort of shift we're envisaging in global energy consumption where we'll increasingly rely on the grid. So over the next several years, we're anticipating this massive expansion in the global grid, if you like, right? So this is again part of this major capital investment that's required over the coming years to build that infrastructure. And the question then is, where is that money going to come from? Will there be enough funding for it? And if there isn't, then of course the effects of protecting people from climate change will be there'll be less protection essentially, and there'll also be more and more resources being switched away from other essential investments. And that's where we're concerned as UNICEF, because if we don't see sufficient investment in the green transition, we expect there to be greater effects of the climate on children, and we expect more and more resources to be drawn from existing investments for children. So what we need is a lot more finance in this major, ambitious transition of the global infrastructure stock.
Yeah, and a lot more conversations like this, hopefully, to bring people's attention to it. Really important from an investment, from an economic, from a human perspective. Christopher Callahan, Dartmouth doctoral candidate, and Lawrence Chandy, principal advisor for economics at UNICEF. Gentlemen, thank you so much.
Thank you.
Thank you.
We got much more markets action ahead. You're watching Yahoo Finance. Biden 2024, good or bad for stocks?
I think good. I think Biden has been sort of the stealth president in some ways. You know, there were some new studies out that people are not in favor of his economic policies, but you know, for better or worse, we have largely full employment. Inflation is getting better. I don't think he's necessarily a bad thing. I think the messaging is just, he's never been able to message, and I think that tends to be his biggest issue. I don't think he's really a problem for the economy.
A U.S. court ruling allowing the $69 billion Microsoft Activision merger deal to proceed was a big blow for the FTC last week. The agency's antitrust push and its focus on big tech specifically has been no secret. Today, it paused its in-house trial against that acquisition, opening the door to settlement talks. It's not just tech, though. The Department of Justice and the Federal Trade Commission have both taken on companies and industries from airlines to publishing and national security. Last year's high-profile battle over Illumina's purchase of Grail ultimately landed in the FTC's favor, but only after an appeals process. In that case, the commission said the deal would, quote, diminish innovation in the U.S. market.
All right. Well, protecting this innovation is key for both agencies. Now, the FTC and the Department of Justice have released a draft update on merger guidelines. It will be used to guide its review of deals and determine their compliance with federal antitrust laws. FTC Chair Lina Khan has faced strong criticism from Republicans for the agency's sweeping antitrust agenda under her leadership. Speaking on the guidelines, she says, quote, open, competitive, resilient markets have been a bedrock of America's economic success and dynamism. Faithful and vigorous enforcement of the antitrust laws is key to maintaining that success, end quote. Now begins the process of public review before they are finalized. Joining us now with insight, Jonathan Cantor, Assistant Attorney General of the Department of Justice Antitrust Division. Thank you so much for joining us this morning. So let's get into these regulations. And we have a public review period up until September, correct?
That is correct. So we, because of the, first of all, thank you so much for having me. It's wonderful to be with you all today. The importance of these guidelines is so significant that we have set forth a longer than usual process for public comment. So it will be 60 days, and that will expire at the end of September. And we're extremely eager for input from the general public, all stakeholders.
And Jonathan, Rochelle here. I'm looking at the guidelines here, the 13 guidelines. In terms of the ones that are the most significant changes that people should be aware of, especially given the success rate of the FTC in trying to address some of these mergers, what do you think are the key standouts among those?
Yeah, so we built these guidelines. First of all, let me say very clearly that these guidelines are not the law. The law has not changed. The law was written by Congress. It's been interpreted by courts, including the Supreme Court, and we built the guidelines and we designed them to provide transparency regarding our agency practice in a way that reflects the law. So these are the first guidelines ever since they started in 1968 to cite to cases, and we do so extensively, to binding and relevant precedents, including from the Supreme Court, because our merger enforcement, our antitrust enforcement is law enforcement, and we want to be guided by the law.
So I guess it's Julie here, Jonathan. I guess I'm trying to understand then how you use the guidelines, right? If the law exists, then what do the guidelines do?
Yeah, so the guidelines help provide transparency about how we apply the law. So as the agencies, we have to get filings. When parties want to merge, they submit filings to the Antitrust Division and the Federal Trade Commission. We examine those filings to determine if the merger will substantially lessen competition or tend to create a monopoly. That involves an in-depth process sometimes. More often than not, we don't have anything to say about it at all, and most mergers go through without any investigation at all. But in some instances, if mergers threaten competition, we have the opportunity to investigate. And these guidelines explain how we go about applying our legal framework to the market realities of today and focusing on the realities of how markets actually function here in 2013.
So one of
2023.
It's okay. You went back in time a decade. All right, but one of those mergers that was that was in focus. It was the FTC had sued to block this. The Microsoft Activision deal. It's proceeding. Are these rules, to follow up with what Julie was asking, is this just lip service?
Not at all. So first, let me say these guidelines are forward-looking in nature. They don't relate to any specific case. The case you mentioned is pending over at the Federal Trade Commission, and I defer to my colleagues over there regarding the specifics of that matter. I will say that we've seen a great deal of success in our enforcement program. We've challenged and succeeded in court in blocking the Penguin Random House Simon & Schuster merger, the American Airlines JetBlue merger. And when we look at the total number of trial victories plus abandonments, either post-litigation or prior to litigation, we've seen success in over 15 transactions. That is, a record that I'm extremely proud of. And one of the things that we do is we follow the facts in the law, and we make sure that we're applying the law using state-of-the-art economics and analytical tools. And that's what we've done in creating these guidelines, is we've built them around the legal foundation that courts are going to apply when we bring cases before them.
And Jonathan, obviously some of these multinational companies here, and sometimes you'll see the EU rule a certain way and take a certain lead. How much are these guidelines influenced by some of the actions that you've seen perhaps taken by the EU on some of these merger decisions?
Yeah, so again, I think the law has not changed, right? The law was written by Congress. It was very clear that if a merger, it's a risk assessment, may substantially lessen competition or tend to create a monopoly, then we have the ability to intervene. And that's what we're doing. And so the guidelines are really designed to help explain how that law might apply or how we might go about investigating as part of our agency practice to apply that law. Now, there's an important nuance here, which is that, and I'll get it right this time, in 2023, our markets look very different than they did 50 years ago when phones had rotors, or even 15 years ago when most people, not my dad, would stop at a gas station to ask for directions. And so
nobody's dad, Jonathan.
Yeah, I know. I'm a dad now, so I'm familiar with that affliction. But I think market realities have changed, and it's important that we're using state-of-the-art economic analysis to apply the law to how markets actually function. And so when updating these guidelines, we've not only made sure to, in our view, faithfully and accurately reflect the state of the law, but we've also made sure to faithfully and accurately reflect the state of market realities in economics and economic analysis as it exists here today in 2023.
So there's some criticism that this is political when you are unfairly targeting certain sectors like big tech. What do you say to that?
So I encourage anybody with those criticisms to read our guidelines, because what you'll see is they're business model agnostic. They don't focus on any specific companies or any specific businesses. It simply says we want to protect and preserve competition. It focuses on competition. And in order to protect competition under the law, we have to make sure that we recognize market realities. Market realities today include data. It includes platform technologies. Markets are no longer two-dimensional and vertical or just horizontal, but they're multidimensional. And this is not just true for consumer tech or enterprise tech. It's true across our economy, healthcare, energy, industrials, fintech. It's everywhere. And so it's important that those economic realities are recognized, and that when we apply the law, we're doing so, again, with understanding of how our markets function today.
Jonathan, speaking specifically about Microsoft Activision, obviously that was a defeat for the department and the FTC.
Well, just very clear, that was an FTC case. It's ongoing and it's Trade Commission. I can't comment on that, but the department did not have a role in that matter.
Okay, because I was going to ask how do you think the approach could have been different, or what exactly is at the heart there that the court disagreed on that perhaps could have been overcome?
Yeah, again, it was an FTC case, and it is pending. And
Jonathan, let me ask you this. So with the rules, what industries or what kind of mergers does this place tighter scrutiny on?
So this is really, again, designed to be focused on protecting competition across all industries. So we've started our analysis with how does competition in this market present itself? And we're focusing on the companies that have market power. We're focusing on mergers that create clogs on competition, that create monopoly power, that extend monopoly power. And that can occur in any industry. It can occur, if you look at our cases, we focused on book publishing, we focused on industrials, we're focusing on healthcare, we're focusing on aviation, and we're focusing on tech. We're focusing on all of it. And so, again, these guidelines are really designed to apply across our entire economy and work to the benefit of the competitive process, which in our view really is a benefit to all Americans and American prosperity.
And Jonathan, just quickly, who is pushing for this? Is this perhaps smaller companies? Are the public really pushing for this?
Yes. We had a public comment process in issuing these guidelines initially to get input on creating them. I think the last time they were drafted in 2010, the comment period generated about 30 or 40 comments. This time it generated over 5,000. And those comments are not just coming from industry trade associations or Beltway insiders. They're coming from nurses, emergency room physicians, pharmacists, independent grocers, workers, citizens who care about these issues. We are hearing continually from businesses, entrepreneurs, that they want the opportunity to start business, and they want to do it in the region of their choice, not just in one part of the country or another. We're hearing over and over, not just from small companies, but from big companies, that they want the opportunity to compete based on the merits of their innovations, their pricing, and their customer service. And so unless you're a monopoly, you actually really do want the opportunity to compete. And you'd be surprised how often we hear from businesses of all shapes and sizes asking us to enforce the law so that we can provide opportunities for companies to compete.
And we'll certainly be keeping an eye on those guidelines and see how many companies actually adhere to them. A big thank you there for taking the time to join us on Yahoo Finance this morning. Jonathan Cantor, Assistant Attorney General of the Department of Justice's Antitrust Division. Thanks so much.
Thanks for having me. It's great to be here.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What's the one thing you'd splurge on if you won Powerball?
A penthouse apartment.
A penthouse in any particular city or in New York specifically?
New York.
Of
We're
course.
in New York. New York.
On Thursday, the Senate Committee on Banking, Housing, and Urban Affairs met to address deposit insurance reform. After the failure of Silicon Valley Bank and Signature Bank in spring, regulators were prompted to cover billions in customer deposits that hadn't been insured by the banks. Our next guest was at those Senate hearings, noting that the committee chair, Sherrod Brown, framed the issue as a matter of community banking competitiveness. Punchbowl News financial services reporter and author of The Vault, Punchbowl News' new newsletter, Brendan Peterson. He's joining us now to discuss more. So what kind of stood out to you here, and is there actually going to be reform on deposit insurance?
Thanks for having me, Julie. What stood out to me more than anything is that Democrats have a lot of, shall we say, disparate ideas on what to do now that we're about 4 months out from the initial collapse of Silicon Valley Bank. You have to remember that deposit insurance really took on a central role during the mini banking crisis of the spring. Regulators had to step in and protect a whole lot of uninsured deposits that they normally wouldn't, but they were worried about the health of the broader financial system. And whenever that happens, lawmakers say, maybe we should reopen this law because you'll recall the FDIC's insurance cap has been set at $250,000 per account holder since 2010. It hasn't changed in a really long time. But listening to Democrats yesterday, you did not hear much cohesion of ideas. Sherrod Brown, yes, did talk about community banks and said, look, if we don't raise the threshold for deposit insurance, the big guys, the biggest banks that we know regulators will not fail or not allow to fail, are going to suck up all the deposits if people are worried about the safety of their banks. But other lawmakers are all over the place on this. We heard Senator Bob Menendez says he was actually worried that if we raise the deposit insurance cap, smaller banks might be hurt because that's fewer accounts being spread across the financial system to get that full coverage. So this is not fertile ground for broad legislative reform, even on something as technical as deposit insurance reform, because financial services legislation is really tough. You need that cohesion. And I asked Sherrod Brown after the hearing, do you think you have a path to consensus? And he told me he doesn't see it right now.
I mean, with that in mind then, say they did perhaps raise that ceiling over 250,000 there. What does that mean in terms of responsibility of banks? Can they then afford to turn, more of a blind eye if they know that even more will still be protected?
That's a great question. There is a certain amount of, and this is something that Tim Scott of South Carolina brought up a number of times yesterday. He said that there is a cost to raising the deposit insurance cap. Now, there's different ways to interpret that. On the one hand, the higher the government's threshold for deposit insurance is, the more money that we would expect banks to have to pay the FDIC for the privilege of deposit insurance. Because remember, the deposit insurance fund is actually funded by bank assessment fees. They give a certain percentage of their assets every year, or every couple quarters, I should say, to actually fund that fund. So if there was more coverage, they would presumably have to pay more. That would probably be balanced out by a little bit more risk taking, but it's really hard to generalize on that front. But people worry about that. Moral hazard is a huge concern for bank regulators, right? You really don't want to take off the speed limits when it comes to banking. That's when we get into trouble.
And were there any proposals that seem to be getting more support than others, whether it's the camp that says leave it like it is, or the camp that says no, we have to change this and increase this deposit insurance? Where did it seem like there was any support gathering?
I'll say this. There is a thread from the Silicon Valley Bank collapse specifically that has carried through and has some bipartisan energy. It's just hard for me to see this as a standalone issue. But this has to do with payroll, right? One of the huge issues with Silicon Valley Bank when it collapsed is it was holding a lot of money for a lot of important companies when it came to making payroll. And the way payroll often works at a business in the United States is you might suddenly drop $10 million into a single account that's going to go out the next day. So you don't really need deposit insurance for that account because you're assuming the bank isn't going to fail in that 24-hour period. But in the case of Silicon Valley Bank, that's kind of what happened. And so there's some conversations about just putting payroll accounts into their own category and letting the deposit insurance fund basically cover that indefinitely, right? Only because it is so disruptive for employees to suddenly not have their pay. And it's so unlikely that a bank would fail while that money is effectively in escrow that it's a kind of a lower hanging fruit. We heard Senator J.D. Vance talk about that yesterday during the deposit insurance hearing. He has a bill that would do something to that effect. I'm not sure if that bill has actual bipartisan buy-in specifically, but I've heard that from a number of lawmakers, right? This is sort of it's kind of a Band-Aid fix, but it is a palatable Band-Aid. And that is often what it takes for Congress to pick up legislation.
I mean, but low-hanging fruit and how, Brendan? I mean, obviously that's important, but it's pretty minor in the grand scheme of things in terms of if you're looking at systemic risks in the system. I'm curious about the parallels between this time and, say, the financial crisis or other times that we have seen financial legislation get through, reform legislation get through, in terms of a crisis happening and then action happening and how long it takes, right? So are there any sort of lessons to be taken away or parallels to be drawn?
The problem with this mini financial crisis is that the damage at the end of the day was not all that bad. And I say that like it's a problem. I guess it's probably a good thing that didn't happen. But it remains it should be said that ultimately the system kind of worked, right? A lot of people were grumpy about the way in which the Biden administration invoked the systemic risk exemption to cover those deposits. But ultimately, and regulators since, like Janet Yellen and Michael Barr at the Fed, have made very clear that they believe invoking that systemic risk exemption was exactly what the systemic risk exemption is for. It's why it still exists in law. And B, it worked. Like, it prevented a calamity, a collapse. And so when you think about that, you can make the argument that, sure, maybe deposit insurance limits are due for a little bit of a raise, but the system is working. I mean, it absorbed three of the largest banks to have collapsed in the United States in history. And so if the system can tolerate that level of stress, then arguably it is working, maybe not as intended, but in a way that is functional. Financial crises really need to break bad before lawmakers start to think about broad-scale reform. Even with the 2007-2008 global financial crisis, Dodd-Frank was not a given. It came close to not making it across the finish line. And I think in one iteration, when you're talking about things like TARP and other like sort of emergency measures, those did not pass on their first go around. They had to go again. And so nothing in financial services legislation is a given whenever the system begins to bend and even break. It takes a lot of political will, even when you had the margins of the Obama administration when it came to Democratic control of Congress. So it's really tough to say.
That's fascinating, and it's still interesting to see that even after all these months, still not able to get lawmakers on the same page about what to actually do with this reform. Fantastic breakdown there for us. Punchbowl News financial services reporter and author of The Vault, Punchbowl News, new newsletter, Brandon Peterson. Thank you so much. Have a great weekend.
Thank you.
Well, Americans want to buy new homes, but there's not enough to go around. Yahoo Finance's Rick Newman did a deeper dive into this issue in this week's Bidenomics, and he joins us now. Hey, Rick.
Hey, guys. So when we started seeing interest rates going up last year, a lot of people thought, oh, that means housing prices are going to go down, and maybe all these buyers who have been locked out of the market might get some relief. That's just not happening. I mean, very unusual convergences in the housing market. We got new data this week. Existing home sales are down. People are just not putting their homes on the market because most homeowners with a mortgage refinanced and they have a super low mortgage now and they don't want to give up those savings. So we're seeing existing home sales go down. There's not enough new home construction for a variety of reasons. And prices, which a lot of economists thought would come down, they're almost back to record highs. So is this a problem for President Biden? I think yes and no. A lot of the housing market is local. It depends on zoning and permitting and what local governments say about where you can build, and there are a lot of problems there. But Biden has promised to help with affordable housing, and he actually has put some stuff into effect, and it's not working yet. So some of the things Biden has put into motion may help in I don't know, the next year or two or three, but right now it really remains a snarled housing market, very frustrating for many people who are trying to buy.
Rick, quick question on former President Donald Trump. We got new news on a court date. Take us into where things stand. I know former President Trump was hoping for a delay. Where is it now?
So this is the federal prosecution of Trump on the classified documents charge that's being handled in Florida. The judge in that case has set a trial date for May 2024. And I mean, it really could not be more dramatic, assuming that date holds. So in a close primary election, that would be right around the time that either party, the Republicans or Democrats, are deciding who their nominee is. Now, if Trump or somebody else really dominates, we might know who the nominee is before May of 2024. But remember, the conventions are usually in either July or August. The conventions are where they formally nominate their candidate. So if this trial happens on that date, I mean, it's going to be square in the middle of the Republicans trying to figure out who their candidate is. And obviously, I mean, could be the biggest factor by far in the 2024 election.
All right.
All right, always great to get your updates. A big thank you there to our very own Rick Newman. All right, before we go, let's give you a quick check of the markets so far this morning. We see all three major indices still in positive territory, though trading in a relatively narrow range. The Dow up about 63 points or 0.2%. Similar story there for the S&P 500 as well as the Nasdaq. Still expecting, of course, a lot of volatility today as the Nasdaq 100 rebalances. And of course, we're getting those options contracts expiring for stocks, indexes and ETFs as well.
All right. Take care.
All right, stay with us on Yahoo Finance. Much more coming up.
You're watching Yahoo Finance. I'm Julie Hyman. Well, Tesla and Netflix provided the record scratch for the earnings season thus far yesterday. And this really speaks to how high expectations are, particularly for some of these big tech companies. And guess what? They didn't meet those expectations. With me, Miles Udland, Shauna Smith, Josh Schaefer, to talk about the expectations game, to talk about Tesla, to talk about Netflix, talk about everything, I guess. I don't know, Miles, where should we start?
Well, everything through the prism of just two things.
Yeah,
the best way always to tell a story. I think what's been interesting to see, obviously the reaction we saw yesterday in the two stocks, both Netflix down 8%, Tesla down 9%. Clearly there was some thought that there might be this hole. The bar is so high that you can only disappoint. Of course, look back at the stocks year to date, doesn't really make a huge dent in that run so far, but it also comes, Josh, during a week where we've seen a broader rotation within the market. Cyclicals are really doing the leading this week. We've seen the Dow outperforming, and I think we can go through the details on Netflix and Tesla and how sensitive investors were to guidance, but ultimately it does feel at a market level like we're getting some sort of answer to the question of, has the rally been too narrow? Well, right. I guess not. I guess now we're broadening it out. This is the moment where it broadens out.
Right, and it's starting to broaden out more, and it'll be interesting to see how it happens when those companies start to report as well, too, right? When we see more companies report, you have about 40%, I think, of the S&P 500 reporting next week, so we're going to get a little bit of a clearer look at it. But I think one thing that was interesting when you think about Tesla and Netflix, too, and we've talked a lot about the AI started run, right? The AI started this rally, and it's been an AI-driven rally. There's still a debate if Tesla's an AI company, right? I think that's a little bit out there. And Netflix really isn't an AI company. You're really getting those reports next week. So we're actually going to see how the market's reacting to the tech rally and that AI rally, I would argue, more next week when companies start talking about it and their products actually have to do with AI. So I don't think that's quite the read here. I think there's been a little bit of, tech, people are trading down or trading off, selling some profits, and I think it'll be interesting to see what happens next week when we actually get tech earnings.
Yeah, I agree with that. And I also just think that these two results, at least so far, was kind of a reality check, Julie, going back to what you were saying, just in terms of the misses and the fact that they didn't really quite match investor sentiment, right? The expectation was very high for these two reports going into these results, and investors found something wrong with both. When it comes to Netflix, it was the revenue, it was the guidance. When it comes to Tesla, obviously, it was the pressure that we have been seeing now for 2 quarters on margins. And that's something that investors are worried about. This rotation, I think, helps investor sentiment in terms of this broadening breadth that we are starting to see in the market. Whether or not, though, earnings season is going to be enough here, the results that we've gotten so far, to keep this momentum going to the upside, I think that's still too early to tell, given the fact that we have so many very important results still ahead.
Yeah, and these two companies, they don't, they're not as much AI centered, right, as the companies that we're yet to hear from. I thought it was interesting. We talked with longtime tech investor Paul Meeks in the last hour, and he said, he wants to see the goodies, I think as he put it, when it comes to AI. Like, when is this stuff going to actually start making money for these companies? Not just these things are in development, this is what we're working on. When is it going to start to make money? He says that's not going to happen yet, right? It's not going to happen, ex-NVIDIA, I guess, for a little while. But his concern is that because investors are so obsessed with it, they're still going to punish companies for not talking a lot about it. So that'll be an interesting thread to pick up on what you said about AI. That'll be an interesting thread next week.
I guess, then it kind of gets to that question of the company fundamentals versus portfolio construction, because everyone has already chased all these names higher, and they're like, well, it'll be fine. It's been fine for me. I'm making back some of my losses from 2022 by buying every FANG with both hands, essentially. And so whether it bears out for the company, I guess NVIDIA has some fundamental basis there, right? But if I'm a growth manager and I bought a bunch of Meta at the beginning of the year, honestly, I don't really care. Stock's up 150%. I've gotten what I need out of it. Now, of course, it's very possible that I still own a bunch from the record high back in 2021, and so I might, still be having some issues there. But I think we get into this phase of the market rally, the reset phase, and you saw it, that kind of furious peak into the end of the first half of the year, because you're setting up, okay, what's my client letter going to say? Well, it was good when you sent it out in July, and now it becomes this question of what do I do for the third quarter? How do I get this thing in the house for the full year to say it was actually a good year? And the answer might be, well, I just sell all the names that went up a bunch, and I actually don't really care if they make money on it this year. Maybe
not a bad trade, right?
Yeah.
An interesting part too, Shauna, that you were talking about that I wanted to highlight when we talk about those companies missing on sales. I thought it was interesting to see how the stocks have reacted versus if you miss on sales, you miss on EPS. Julian Emanuel over at Evercore does a great job of tracking this and where companies get hit the most the day after. And companies that have missed on sales but beat on EPS have actually had the worst stock reaction of earnings thus far. They're down about 4%. You could see actually not doing better than companies that double miss, which are doing worse, than companies that double miss, which is quite interesting. And then when you can look at the 5-year average, companies are not normally hit that hard when they miss on revenue, but beat on EPS. So people focusing a little bit more on those. You could also argue that they're just the bigger companies that we've seen so far.
My kind of takeaway from that graphic is so it's a bull market. it's an economic expansion, because essentially if you can't grow the top line, which is just the basic, can you sell more goods and services, then you're going to get punished, because you can't do the whole like, oh, the macroeconomy is bad thing anymore.
Yeah, and I also think that goes along with the line of thinking that many strategists, many economists were saying in this angle here, going into this earnings season in terms of those expectations and the ability for some of these companies to meet expectations. Also, what I'm going to be looking for is, we certainly have seen this broadening out of the AI hype over the last couple of quarters, and we had Coca-Cola, almost every single industry here mentioning.
Pepsi, I can't believe it.
It was almost the first one that really stuck out when someone was like, wait a second, why are they talking about AI? But how much hype we will see in regards to those names who haven't necessarily, obviously, rightfully so, participated in this AI rally yet, if that's going to be enough to get investors excited about the fact that a lot of these companies are in a position to maybe have a tough couple of quarters, given the fact that consumers are pulling back on spending. They've needed to raise their prices. Pepsi, obviously, the results were very strong, but Coca-Cola, will be hearing from them next week, and whether or not the volume sale there, how big of a hit that is going to take, and whether some of those comments about AI will be able to offset some of that weakness. I don't know.
It probably won't help if you're thinking about the overall narrative that we were just talking about, right, in terms of sales, because AI for them doesn't help sales. But the argument that when they try and make a real constructive argument about it, they try and say it's going to help profitability, right? Because they're going to be able to operate better. Yeah. So if you're looking at it from that sense, then maybe not, because Netflix talked a lot about being good, profitable, right? They had a lot of positive, profitable stats, and people just wanted to look at it as a growth company and be like, where are you giving me more money?
Well, I think what's interesting, looking at that graphic that we just showed from Julian Emanuel, is, to the point of, well, this is an economic expansion. This is a bull market. So maybe in the your first quarter earnings, we're sitting here in April of 2023, and it's like, is the economy good? I don't really know. So Coke, who is a volume business, who needs the economy essentially to be expanding, they're a GDP plus type grower. Yeah. They have to go, they're sitting in the strategy room, let's say AI a bunch, and it'll be fine. Just AI, generative AI, do the whole Sundar Pichai bit. I'm not really sure that for a company, a consumer staple basically, you need to do that or should do that anymore. I don't
think you should do that, but we have seen companies do that.
Well, but I think you should have a quarter ago, because it's like, sure, it's free money, just go for it, whatever. And no one will ask too many hard questions. Now it's like, hey, the economy's doing fine. Like, can your business, do we have a good business here? Let's get back to doing a good business.
Well, I guess we're all done. We're not going to talk. We were going to talk about Elon Musk on the call.
I did a small amount of research for this.
12 minutes.
I don't think it was.
We came in late. I think we came in late.
Whatever the case.
It is 11:12 though.
We'll see you next time. Have a great weekend, everybody.